David Bahnsen joins us right now. He's the Chief Investment Officer over at the Bahnsen Group and has been a longtime holder of Cisco. The results just came out. They were not bad by any stretch of the imagination, but you did not necessarily see those eye-popping sort of figures that you're getting from other companies. We're going to spend X $100 billion on this, or we're going to have, double-digit growth rates there. This is still kind of a slow and steady company, and I'm wondering if you're satisfied with that.
Yeah, I would be unsatisfied if it weren't that. And I mean this very seriously. Easy come, easy go. You're seeing it with CoreWeave, right now. These big violent moves up and down are problematic for dividend growth investors like us. Cisco does have a call option on AI. They have a future growth play that they're very well positioned for, but it isn't something that should be creating a 20% move on the result of one quarterly announcement. Now, to your point, they're up 20-25% over the last several months, and that's why you see a very slight sell-off here today. They beat on top line, they beat on bottom line, and they didn't adjust forward guidance either. They actually increased modestly the bottom end of that range. The issue is that it's trading at 15 times next year's earnings. The other companies you're talking about are trading at 50, 60, 70 times next year's earnings. And so Cisco clearly is not being looked at by the market as that type of major quick growth story. 800 million, $1 billion in AI, that's just fine by us.
Yeah, and it's kind of interesting you bring up those multiples. I mean, obviously, when you put them up against some of those names you said, but even some of the more pedestrian names like, Broadcom and HPE, we're talking about multiples that are way higher than what we see with Cisco. What do you want to hear, though, from Chuck Robbins? I mean, I think everyone knows that he has done a relatively good job in trying to steer this company into the new future. But now you're at this critical stage where everyone wants to see more. What do you want to hear from him?
Well, I want to hear that they're continuing to grow the percentage of their business that's coming from recurring revenue. I think that's the future. You've seen IBM be incredibly successful in a lot of that transition. And essentially, Cisco has a great business with those old school businesses that we talked about. That networking equipment, that hardware, it's come down to about 48% of business. I like the fact that recurring services are now at this point about 38% of business. When we first invested, it was barely 20%. That gives you a better multiple. It gives you a better foundation of recurring cash flows. That's how Cisco's been able to grow the dividend at over 7% per year for a decade. So this is not a new tech company. They're old tech that is doing a lot of new tech things. That's a great combination for investors like us.
We were talking to a guest earlier today, and she was kind of talking about what she wanted to see out of Cisco longer term. And there was a discussion there about acquisitions. And I am curious, as an investor in this, would you be comfortable with Chuck maybe taking a more acquisitive approach to growth rather than just organic?
Well, first of all, when Cisco's stock was at the ridiculous levels in 1999, they acquired a lot of companies, which is the reason they lived to fight another day. When the stock dropped to 90%, they had used their expensive currency to acquire a lot, and then they grew wonderfully for 20 years. They just simply had a stock price that had to repair from bubble bursting. The Splunk acquisition was $28 billion, so that's a very acquisitive, transaction, and on the high end of what I would ever want them to spend. The Duo acquisition, I believe, was only $4 billion. They've got a really good position in cybersecurity. So yes, I like using M&A, but they have to do it diligently. I wish everybody would do deals diligently. Some companies don't have to think about that because their stock price is so expensive. They're just using a really high currency to go acquire. Cisco has to be very cash flow accretive to make deals work.
When we talk about, and I'm glad you brought up the Splunk, because there have been some people that are saying that when you look at the results that we've gotten over the last couple of quarters, and more importantly, the guidance going forward, that a lot of that has to do with Splunk. Not necessarily just in terms of one for one, we're going in, but the idea that it added a security bona fides and some other things that Splunk was able to bring to the table that makes the ultimate Cisco product, I guess, as a package, a little bit more attractive.
There's no question about it. That, look, as much as I love their old school businesses that have very high free cash flow productivity, Cisco would be trading at 9 times earnings if all they were was selling routers. The multiple that they have that has come up higher is a result of the Splunk acquisition, that hybrid cloud AI play coming together. Look, I was concerned with what IBM paid for Red Hat. I was concerned with what Cisco paid for Splunk. They validated those M&A transactions. They become very successful for the growth trajectory of the business.
Is there sort of a role in that broader AI ecosystem where you can see Cisco maybe getting a little bit more of the hype that goes along to, whoever the CoreWeaves or NVIDIAs or whoever else, if you will? I know you're kind of poo-pooing that. I know you're more of a value dividend guy, but that hype, it helps sometimes, right, David?
Well, it could also help us to get paid 5 years worth of return in 1 year and end up having to exit the position. I mean, it could happen, and everybody would be very happy if it did. It's not what their business fundamental is. It's not what their business culture is. But it's entirely possible that they're basically showing up at the right dances, and then you could end up with a very good situation. So, yes, that's why I refer to it as a call option. It's not priced into the stock, but there is that opportunity for that asymmetrical upside. But what they have to do is block and tackle, because it is a value-oriented company. You're not trading at 15 times earnings that people expect you to become the next NVIDIA. What they are doing is exactly what they should be doing, with some asymmetrical opportunities to the upside.
All right, David, got to leave it there. David Bahnsen, the CIO there over at the private wealth management company, the Bahnsen Group, and a holder of Cisco.